Hello and welcome to MF Corner. I'm Sonal Bhutra and with me is Vinnii Motiwala. And as always, we'll talk about how to do your mutual fund investments to achieve goals in life. And today, the final goal is quite fun. It's going to be about travel, but about education as well.
Absolutely, travel and education. Travel is for me. Education, maybe you can pick it up given that...
I'm very well educated. I'm just joking.
But yes, we can do that. Inflation is increasing everywhere and we need to know how to, up that inflation, make more returns as well. So today, firstly, we're going to start discussing about your vacation budget. How can mutual funds actually help you, plan your holidays? What should you be investing in? Near-term, long-term goals on your vacation holiday? How should you be budgeting this? To talk to us about that, we have Varun Fatehpuria, who's the founder and CEO at Daulat Finvest, as well as Prableen, Bajpai, founder at FINFIX Research and Analytics, joining in with us to talk to us about that. Varun, as well as Prableen, good afternoon, and thank you so much for joining us on the show. Let's start with the vacation, right? Everyone wants to align their investments with vacations, the budget that comes in over there. And everyone wants a holiday every year at least. One holiday is what you want. How should, you use mutual funds and different categories, different types of mutual funds to actually budget this vacation? Prableen, first, if you could start with that.
Good afternoon, Vinnii. Mutual funds definitely give us a great variety of products and categories which are available to investors to align their vacation goals, of course, and other different goals, because we have specific categories which are well suited for a different time period. So while planning your vacation, the key is first that the investor or the person who's traveling or planning their travel has to decide on the investment horizon, that how far is the vacation. And that's the first step. Because let's say if the vacation is going to happen in 1 to 3 years, then the focus has to be on capital preservation. There has to be liquidity, and we are not looking at any volatility there. We want something which is going to stay more stable. So let's say debt funds, arbitrage funds, there's this new category, which is the income plus arbitrage. These become the preferred options. And of course, within these, which category or which particular scheme would suit the investor will also depend on their own tax liability and the exact horizon which they have. But of course, the focus remains on capital preservation, and thus we are not really looking at high risk and any sort of high returns here. But we are just setting aside that amount to be able to cater to that holiday which is going to be there in the next 1 to 3 years. But Vinnii, let's say if this travel is 3 to 5 years away, then probably there is some scope of growth as well as undertaking a little amount of risk, and that is where hybrids come in. And I think within the hybrids, balanced advantage funds, multi-asset funds can be good categories to go for. And there are a lot of schemes which even during the previous fall, which happened from September till April of 2025, were able to contain the losses at 1/3 of how much Nifty fell. But of course, again, investors will need to see that they're looking at a slightly conservative sort of a hybrid fund here and not picking the risky one, because the highest fall was even up to 24%. But hybrids, I feel, can be the go-to category for this 3 to 5 year period. And if the vacation is, if you're really planning for the long term, and if you're planning a vacation after 5-7 years, then I think, of course, you can have the regular equity exposure, but more towards the large caps, so that you have a certain amount of growth, which is able to also negate the inflation, which is going to happen in that time period.
Take that point. Varun, let me come to you. What are some of the mutual fund categories, according to you, which can be looked at when it comes to funding your vacation? And adding to that, because we are factoring in inflation, there are travel costs which are fluctuating. How can one plan their corpus, especially when we are talking about volatile economic periods?
Yeah. Hi, Sonal. Firstly, thank you for having me back on the show. I would just allude to a lot of what Prableen had mentioned with respect to having a very clear understanding of what your time frame for investing in. And then because mutual fund gives you such a lot of varieties with respect to the schemes that you could choose for, that you could pretty much customize any sort of a travel goal that you have for yourself, depending on when you want to take it, right? So obviously for shorter term time periods, anywhere between 1 to 2 years, where your goal is capital preservation, always stick to debt funds. And in debt funds, you could look at categories like liquid, ultra short, even perhaps money market funds, right? Where the goal is to provide you with capital protection and hopefully over a period of time, give you a certain percentage of points over and above the inflation. So those are the categories that you could look at in the debt category. If you're, let's say, planning for a vacation 2 to 3 years down the line, then you could start potentially looking at some allocation to hybrid strategies. And even within hybrid funds, which predominantly have a bias towards fixed income. So something like an equity savings fund or a balanced advantage fund, or even in some cases, conservative hybrid funds, or even in some cases, very specific multi-asset allocation funds, which provide you sort of like a fixed income like experience, but with a favorable equity taxation. So these are the strategies that I would consider for, let's say, goals maturing in the next 1 to 3 years. And second thing which investors need to definitely keep in mind is take into account inflation, right? Inflation, the headline inflation could look anywhere between, let's say today the print is at about 2 to 3%. But I would definitely recommend take that with a pinch of salt, maybe even 4 to 5%, because once we go out to travel, we see that definitely prices have significantly jacked up from when we were there maybe a year or two back. So domestically, if you're traveling, take that into account. And if you're traveling internationally, then add some currency depreciation as well against the INR.
Prableen, on the inflation point also, is there a possibility, right, when you see inflation, the number increasing, then maybe you should start stepping up that SIP? Is that a possibility? And when you're reaching closer to that vacation date, how do you start transferring? Is there a transition of your investments from those high risk to safer bets or safer instruments that one could look at? How should you go about that as well?
So ideally, Vinnii, this strategy can be implemented if you have a vacation goal which is around 5 years away and plus. Because if the goal is, let's say, 3 years away, so today a cost of 3 lakhs for your travel, even after 3 years would come out to be about 3.67 if you're looking at 7 to 8% inflation. If you're planning to go abroad, the same 3 lakh would almost become 4 lakhs considering higher inflation, because last year, like we saw, there have been so many reports where actually international travel expenses really moved up since January of 2024 to now. Rupee has depreciated almost by 5%. So all of these need to be factored in. But sadly, if the time horizon is very short, like for a 3-year period, unless and until you're doing a lump sum, and there also you'll have to take some risk with a hybrid fund, you can't actually gain the kind of returns you would want to beat this inflation. So the amount of investment will need to be higher. But having said that, yes, still you need to set aside a decent amount of money so that you don't indulge in taking last minute loans or other avenues which are in fact going to be a cost in the future for you. So definitely setting aside that corpus and stepping up is a great idea if the horizon is slightly away, and moving from your equity. Let's say if you do have an equity portfolio which you've created and the goal is coming, it's close by. So as a standard rule, definitely, Vinnii, we do recommend that, there has to be, we have to ensure safety of capital, and, you're looking to sort of lock in your gains which you've earned in equities. So gradually moving into something safer makes sense. So STP can really reduce the timing risk, so that you're not sitting with your equity allocation to the last minute and then waiting to move out. So STP becomes a good option. And also, Vinnii, one more thing, that sometimes during your cleanup or during the portfolio reviews, there are certain schemes sitting in your portfolio which probably you didn't even allocate for your vacation. But let's say that you feel that needs to go out and that churn is required. That can also be used for a specific goal such as vacation. And your additional corpus which you have, which you're planning to invest, can actually be diverted towards something that is which you feel can add more merit to the overall portfolio.
Got it. So Varun, your take on this one is systematic transfer plan as we approach vacation, the right way to go about it. And when we talk about funding vacations, what are the advantages of funding vacations, say through mutual funds versus taking a personal loan or other ways as well? And how does discipline of SIB contribute to making travel dreams more affordable? We don't want any stress here as well, right?
No, definitely. I think coincidentally, just today, a report came out that about a third of the Indians actually take out personal loans to fund their vacation or fund their personal lifestyle, which in all honesty is something that you could try to avoid to the extent maximum possible, right? Because there are a couple of reasons for that. I think when you're taking out a personal loan to fund these kind of expenditure, number one, the cost itself is really high from an interest rate perspective, right? So let's say if we do simple numbers, if you're borrowing, let's say 2 to 3 lakh rupees, on an absolute basis, perhaps you would not be able to see it as such a significant amount from an interest component. But if we actually get down to doing the numbers, Sonal, the interest could as high be as 12, 15, even 20% in some cases. So definitely these are unsecured loans which the banks and NBFCs are lending you to. And so accordingly, the charge is passed on to the borrower. So to the extent possible, try to avoid taking on a personal loan because it also creates that EMI burden every month once you have taken that vacation. On the opposite hand, if you like to look at mutual funds, I think once you have a certain amount of goal that you want to achieve from a target corpus point of view, I think then it is very simple to keep that money aside every month, whether that goes into a debt fund or a hybrid fund, depending on what your overall goal is. But at least it creates a sense of discipline and forces you into a good enforcing behavior rather than taking on loans to fund your personal lifestyle.
Absolutely, this does help you in planning your goals as well, long-term goals, and even better. That's on vacation, how you can fund your vacations through mutual fund. And obviously 3 to 5 years, then you would be better planned right now as well. But on that note, we're going to actually sip into a very short break. On the other side, we're going to be focusing on how to strategize your investments amid the rising education inflation. How should we be going about that? So don't go anywhere. Welcome back to MF Corner on CNBC TV 18. We still have with us Varun Fatehpuria of Daulat, Finvest, as well as Prableen Bajpai of FINFIX Research and Analytics. Now, what we're going to be discussing is going to be education and education inflation that's coming in as well. 8 to 10% is the education inflation. Is it possible to actually beat this with mutual funds, or how should you plan your mutual funds to help you, educate your kids for higher education that you may look for as well? Varun, let me start with you this time. This 8 to 10% per year is your education inflation that we look at. Overseas, then you obviously have that forex cost, additional costs that come in as well. Firstly, how should an investor actually start or accurately estimate that future cost that will come in terms of the corpus that is required, whether it's in India or you want to go and study abroad? How should you go about this?
No, absolutely, Vinnii, right? I think as you correctly pointed out, the education inflation today in our country, and we often speak to a lot of our parents, clients who are planning for their child's education 15 years, 20 years down the line. This is a tingling point for a lot of them, given that the education inflation numbers for not just our country, but if they want to send their children abroad, accounting for depreciation could run as high as 9 to 10%, maybe a couple of percentage points, even more, taking into account currency depreciation, right? So we ran actually some simple numbers to see how do you actually accurately forecast a number that, from a goal perspective that you would like to reach in X number of years, and what could be a potential amount that you could look at contributing either through an SIP or lump sum top-ups over that period, right? So let's just take, for example, today a 4-year undergraduate course in a private US university costs anywhere between 2.5 to 3 crores. And it is important to note here that we're not just taking into account the cost of tuition, but also the cost of accommodation, lodging, living expenses, and the travel to and fro back from your home country. So that number ranges anywhere between 2.5 to 3 crores. Assuming that if I add inflation numbers of 6 to 7% to that, and a further INR currency depreciation of 4%, we are looking at a total annual adjusted inflation number of 10% over there, right? So over a 15-year period, that 2.5 crores actually rises to as high as 9 to 10 crores. So if I were to get to that amount in 15 to 18 years, I would need to set aside roughly 1.5 to 2 lakh rupees every month starting today, assuming my investments grow at about 12 to 13%, right? So we can really see that how inflation and currency depreciation significantly adds to the overall cost, which parents need to keep in mind. And the key is to just start early.
Oh my God, the exorbitant fees that we have right now for even playgroup or nursery. Let me not
Sonal
even
is feeling the pain right now.
Let me not even get started on that. But Prableen, let me come to you, because when we are talking about preparing for it already, what mutual fund categories would be good for that? Which are the most effective in beating education inflation, say over 10 to 15 years? And how should allocation shift as the goal is nearing and you're reaching that high education goal for you?
So I think one is lucky, Sonal, if you start 10, 15 years, you're aware and you've started, because you do have that long time period where your money can compound. And even with a small contribution, you can create a decent corpus for your child's education. And also, Sonal, this is really, really crucial to have a separate education corpus for your child, because by the time your kids are growing up and they go to college, your retirement is also closer. So if you haven't catered to this separately, then, you somewhere can jeopardize your own, take out money from your retirement corpus. So that can be really bad for your retirement life. So it's really important to create a separate education, planning has to be there. So if we just go down and, we take an example of India with, let's say, 15 years tenure and 25 lakh cost today, this would become roughly 1.04 crores in the next 15 years. And for this, Sonal, an SIP of about, if we are just simply taking 12% returns, an SIP of about 22,000 will be required. And let's say if you can't do this 22,000 in one go, then probably 12,500 with a step up of 10% is what can get you there. And let's say if you're taking a fixed income product, Sonal, because a lot of us, we feel that PPF and Sukanya Samriddhi, of course, they're absolutely amazing products because they are totally tax free. So if a 7% product is taken, then you actually require a 33,500 contribution to create the same corpus. So I think each one of us has limited resources. So that extra 10, 12,000, which is going to go every month, I think if that can be saved through equity investing, that can really help, and that can probably be allocated towards the retirement board. Also, even if you are adding some part of fixed income through these schemes, because they do have restrictions of how much can be invested. And I think the education corpus, usually, which is the target corpus, becomes really big. So using them is not solely is not a viable option. But I'll give you an example that if we are looking at large, mid and small caps, the worst performers in their categories over the last 15 years have given 14.5% returns. And the best performers from the large, mid and small, even if they're just taken in the 1/3 combination, has given us 18%. So overall, Sonal, definitely equities remains the preferred choice, with, I think, allocations to all large, mid and small, with a multi-cap kind of an allocation, and international investing, if the limits permit, definitely should be added.
Okay. Varun, your thoughts coming in on, what kind of funds an investor can look to invest for a child's education. Which are those funds that one could look at? And also, how can one actually mitigate that risk that is there? Because when I want to maybe withdraw, maybe 5, 10 years later, and there's a market downturn, then how should I avoid that risk as well?
So Vinnii will take that question independently, right? I think from a category selection perspective, there are two distinct categories one could look at. One is obviously the children's gift fund, which comes with a mandatory lock-in period of 5 years, or the child attains majority, whichever is earlier. The drawback to that is you are fixed to a particular investment strategy from a particular fund house. Right? So there is not a lot of leeway from an investor perspective with regards to the market cap selection or the factor selection or the style selection. The other strategy, which we always recommend, since you have that long of a runway ahead in front of you and the time horizon, go for creating a custom mutual fund portfolio, right? So if you have a 15-year long horizon, I think it's important that you start with a very aggressive allocation to equities, right? And within equities, perhaps you could look at a combination, what Prableen mentioned, of large, mid, and small, depending on what your risk appetite is. But once you start nearing your goal and what you talked about, making sure you have the money at the right time, it's important that we start actually, de-risking the portfolio so that we're not caught in like a March 2020 or an October 2024 situation where over a period of time, our corpus can really go down by 15-20%, right? What we have really saved over a 15-year period. So it's important that I think we start with an aggressive equity allocation. I think once the time has elapsed, maybe slowly start shifting that to a hybrid allocation to offer that balance between growth and capital protection. And then maybe 2 to 3 years, once you're approaching your goal, to make sure the corpus is intact, start doing a switch or an STP to debt funds to make sure the capital gets protected. So this is roughly how we would encourage parents to think about education planning if you have the time by your side.
Okay, all right. We take that point, Varun. And this is, of course, a motivation as well for all young parents to go ahead, start investing in mutual funds for education. I've done that, and I hope that everyone else does it as well. There are a lot more questions, of course, this can go on, but this is very helpful. So I would like to thank Prableen and Varun for joining us today and telling us how to go about first educating yourself well and then going on a vacation after that. So, or do both of them simultaneously. But thanks a lot for joining in today. Okay, with that, we'll do one thing. We'll take your leave on this edition of MF Corner. Stay tuned for Closing Bell to take you through the last hour of trade.